When you consider, though, the run-up we've had and pretty much across all asset classes, or at least the major ones this year, do you look at it as being a healthy run-up, and particularly in light of what people are expecting for 2020, for it to continue?
So let's just take fundamentals. All measures are pressed, whether it's PE ratios, spreads. So as far as healthy, there's not much meat left on the bone. Mm-hmm. So that we would say is less attractive for sure. And what you're doing is you're really factoring in a pretty clear glide path to a continuing of what has been the longest run we've had in the history of really modern finance as far as the economic recovery.
But you're not expecting us to fall off a cliff or anything. I mean, that glide path may be a little bit lower than what we had in 2019, but we're not set up.
How far can we look at? A week or a day?
Well, I mean, I don't know, a year or less.
So I think the glide path into 2020 is risk to the upside, clearly. And the one thing that we can say from our perch within Credit Suisse is positioning in the active funds is so light that that's a tailwind. So structurally, there's a tailwind. Fundamentally, it's long in the tooth. That's as good as it gets in the past couple of years as a risk-on environment.
So what brings the hedge funds actually back in, and then where do they go?
All right, so let's talk about asset classes. They've made money on tech still and beta. They're starting to engage the value play. And the hedge funds that are in the macro space, a lot of headlines about macro managers. We see a bifurcation. The top quartile macro fund is up about 12-15%. They've become tactical. They're playing populism. They're playing the central bank. They're playing the moments. Because the trends, as we were talking about, are long and narrow. It's tough to make money on that, but there are definitely opportunities. And one you mentioned, the CNY move. If you were overlaying the equity markets versus the CNY, every time it appreciates or goes down from like 710 to 7, equity markets go up.
Interesting.
And so that, I think, you're going to see some macro funds go after.
So is this going to be pretty much a macro-driven market in the short term then? I mean, are fundamentals themselves, the fundamentals for individual assets, are those going to be a little bit less important?
I think it's absolutely a macro-driven market. It's been all about central banks and populism trying to offset low global growth. So you've had agents in the administrations and central banks really using their levers in order to offset what has been just a declining rate of change in growth.
What's everyone short? Like, what's everyone going to have to cover?
Yeah, they've already covered a lot because it's been painful. The short book, it's rotated. Do you know what we had? We had the largest covering of value names that were consensus shorts. After the repo market resettled in mid-late September, the run that we had on shorts was one of the more painful opportunity or profit scenarios for hedge funds. So what are they still short? Index, because the idiosyncratic went away. Old economy, still a little bit. But your point's taken. They're short less things right now. Back to macro market, when you have liquidity unleashed by the Fed in a way that has never been done before, last week, where they said OMO, go, coupons back on the table, that sounds more like, if engaged, would abrogate what they said is not QE4, because they are going after duration, as our analyst at Credit Suisse said. So point is, short at your peril at this point.